Welcome to the investment meeting of the Teachers Retirement Board for June 12th, 2025. I'll start by calling the roll. Kevin Lou.
Kevin Lou for Mayor Items, present.
Thomas Brown.
Good morning, Patricia, present.
Gregory Faulkner. John Dorser.
John Doss present, designee as for control Brad Lambert.
Victoria Lee.
Present.
Christina McGrath.
Good morning, Patricia. Present.
We have a quorum. I'll turn it over to the chair.
Great. Good morning, everybody. And we'll start with the Passport Fund's first quarter 2025 performance review. And Amanda, Gina, Goldman Sachs.
Excellent.
Thank you.
So I think Gina's pulling up the March update. We had previously shared the March monthly flash, but we've since finalized the quarterly report. So just wanted to spend a quick minute on first quarter results, which feels like ages ago now. A lot has happened since then. But the first quarter actually was a little bit negative after what had been two incredibly strong calendar years in a row, both 2023 and 2024, where we saw in 23, the Diversified Equity Fund up 24%, in 2024 up 18%. So in the first quarter, down 3%. Really, if you think back to where we were at the start of the year, we had, change of administration, a lot of questions around what the initial objectives and priorities of the new administration would be, and continued questions and uncertainty around the path of interest rates and inflation. We also had a notable event at the end of January with the release of the new DeepSeek AI model that really caused a dip in confidence around the sustainability and the valuations of companies like NVIDIA that have really dominated the AI space. And so we saw a real pullback in some of those big tech names that have dominated US markets. So you see, looking at that 3-month column, in terms of the Diversified Equity Fund, the US equity sleeves were more of a drag. The international sleeve actually did add positively to the Diversified Equity Fund over the quarter, although certainly in both US and international markets, the quarter was a little bit challenging for your active managers. So a little bit of underperformance there versus the benchmarks. But overall, in terms of the quarter, as you can see, kind of mixed results. Not surprisingly, the worst performing option being the Sustainable Equity Fund, which is a US large cap growth option and is, again, very impacted by that pullback in tech that we saw during the quarter. I'll pause there and just see if there's any questions on 1Q.
Questions for Amanda?
Okay. You want to flip over to April? So in terms of April, we ended the month of April at 20.2 billion in total assets for the Passport funds. 18.2 billion of that is in the diversified equity option, so just around 90% of the assets in that diversified equity option. And if you were to look at that 1-month column for April, you wouldn't necessarily know that it was an incredibly volatile month. Actually, most of the returns here on the month look pretty modest and muted, right? The Diversified Equity Fund up about 20 basis points for the month on the whole. But as you all, I'm sure, are very aware, we saw on April 2nd what the administration calls Liberation Day, with the announcement of pretty sweeping tariffs across trading partners. And as we all sat here the morning of Thursday, April 3rd at the investment meeting for April, markets reacted very negatively, both to the announcement of the tariffs and also some of the reactions and threats of retaliation. And so we did have a number of very negative market days following that, although on April 9th, with the sort of rescinding of some of that initial tariff announcement, a pause on the policy, the S&P had one of its, I think, third best days ever, was up 9.5% on April 9th and made back a lot of those losses from earlier in the month. So Certainly intra-month volatility was very elevated, but we ended in pretty neutral space. Again, the diversified equity fund up 20 basis points for the month of April, and on a year-to-date basis through April, down 3%. So again, the international components being the stronger performers for the month and year-to-date, less impacted by certainly the volatility we saw in April around tariffs and earlier in the quarter around, continuing concerns around US policy and inflation. So just pause there on April. If there's not any questions, the last update we wanted to share is just our benchmark report for the month of May. We don't yet have official passport fund returns for May, but can share benchmark index representative returns. And in terms of global equities, we saw really continued momentum from what we saw in the back half of April in response to kind of de-escalation around some of this trade policy and tariff threats, which is viewed positively in terms of growth prospects. And we also saw strong corporate earnings, pretty benign economic releases, all of which are positive in terms of market reaction. So on a go-forward basis, certainly this story isn't over. A lot of these, as we saw just yesterday, announcements around kind of continued conversations with China. And we also have the current tax bill that is working its way through the Houses of Congress that can have an impact on outlook for US growth. So I would say volatility is expected to continue here, but for the month of May, across the board, modestly positive, kind of single-digit positive returns across markets here for the past month.
Thank you, man. Appreciate it. We move on now to the pension fund performance update, quarterly presentation. I guess Ed is going to do that.
Yes,
Thank you, Ed.
good morning, and glad to be back. I haven't been here for a few quarters. And I have to say, preparing for today's meeting, I gave myself a task not to talk about tariffs, because I'm sure everybody's aware I failed. There's just absolutely no way to get around it, because it changes everything. It creates enormous environment of uncertainty. To put in perspective, yes, it came a bit as a surprise to all of us. The tariffs currently, hard to tell exactly where they are, but probably around 18%. That's the level we last saw in the 1930s, almost 100 years ago. There's a consensus that that level of tariffs contributed materially towards global depression, or the economic global negative outcome in the 1930s, created a lot of social instability. And going even further back in time, we're talking about mid-19th century, when the American economy was mostly almost like an emerging market developing, needed a lot of protection. But I also want to put it kind of in perspective. So unique feature of American economy, two unique features. First of all, it's very complex with many degrees of freedom. And the other part, it's mostly self-sufficient. We actually import less than most other countries. It's about 12% of the GDP. So if we're talking about what we're currently thinking, like 10% base rate for tariffs at 12% imports, yeah, it's bad, but it's about 1% hit. We can probably deal with this. It's the uncertainty whether it's 10%, 0%, 20%, whatever it is, that's what creates an issue. And it affects everything in the broad economy and in the markets, and of course it affects your portfolio. So that's what I want to talk about. Starting with the most obvious impact, the inflation. Can we have the first slide, please? And we just had the most recent inflation print yesterday, so it came slightly higher, 0.1%. Again, not the end of the world. So latest print is 2.3%. Well, you see here two lines. The golden line is the PCE, personal consumption. That's the measure preferred by the Federal Reserve. The white line is CPI, which is more preferred by the markets. But broadly speaking, you can see they tell the same story. The difference really a slight difference in components, mostly how the components are weighted. Less weight on energy, less weight on housing. In PCE, you can see from this chart, it shows last 10 years, PCE historically has been more slow to change, and that's why Federal Reserve prefers it, but they probably tell the same story. So inflation is still kind of cooling. You can see the trend with a golden line, a white line. It's coming down slightly. I think the positive trends. What pushes slightly high are the core services and mostly shelter. So the price of housing stays high and continues to increase. It's moderating slightly. The rent in particular contributed 3.9%. Core services moved up 3.6%. Noteworthy change was that core goods actually reached an increase of 0.3%. And that's unusual. It's a small change. I don't want to make too much out of it. But historically, the trend has been the goods trends toward disinflation and services towards inflation. And intuitive way to think about it, think about your iPhone. It costs roughly the same, like over the 10 years, but every year it's more and more powerful, meaning more and more valuable. But the price stays roughly similar, right? So that's disinflation. And we all know that healthcare is getting more and more expensive. Tuition costs, they always go in one direction. Housing, so services will drive inflation. So this change of 0.3% is actually very noteworthy. And that's kind of the leading indicator of where tariffs may lead us. But probably the most important takeaway for me personally from this inflation, that the actual print missed the expectation. So the broad consensus was at plus 0.2%. It came at 0.1%. This is actually the fourth month in a row when inflation missed the consensus expectation. And I think it's not accidental. I think it's kind of indication of things to come. Like I mentioned before, the worst thing about tariffs is the uncertainty. We never really had in the modern economy an environment when tariffs go to that high of a level. We don't know what may end up. And the economists, since the last tariff environment, 1930s, the economists got much more complex, more interconnections, and they have more degrees of freedom. So there are more ways the economy may absorb this shock, the price shock. It can show through unemployment. It may show through the wages. It may show through many different venues. And I think when you think about the economy, first of all, we have some understanding of the economy. That's probably the economists tend to sound more assertive than they actually are. And it's also a question of data. So we collect a lot of data. I don't mean just the United States, but globally. But most of this data come with a strong lag. What you see being announced, it's usually an estimate, and usually being revised up to a year and a half later. So the true picture of the economy comes much later. So whatever you see in the time series, whatever I'll tell you, my message is take it with a grain of salt. It's an imperfect estimate, and I guarantee you that the real world outcome will be very different. But what we do understand are the broad trends. And can I go to the next page, please? I mentioned before that the realized inflation was below the expectation. That said, the risks are mostly to the upside. But the risks are mostly to the upside for the United States. And you see here the consensus estimate that actually I'm fully supportive of. The red line is the inflation in the United States. The solid line is the realized, the dotted line, the expectation. And the blue line is European inflation. Traditionally, Eurozone had inflation lower than the United States, really a reflection of more dynamic nature of the American economy. But you can see they kind of moved step and step, right? Obviously, the Russia-Ukraine war had more of an impact on Europe, but there's both alignment. It's expected to diverge, and not in a good way. So inflation in the United States is likely to drift higher. Inflation in Europe and broadly outside the United States is expected to drift down. And when we think low inflation is a good thing, yes, but it's all about levels, right? When inflation dips very low, it's actually very destabilizing for the economists. Inflation is a great shock absorber, as long as it stays moderate. Like that's why economists typically use 2%. It's kind of Goldilocks environment, right? So for the United States, inflation, for the rest of the world, destruction of demand, nobody benefits. It's a lose-lose on both sides. Just a question of time before we see it filtering into the economy, into employment, into markets, and again, to your portfolio. Unfortunately, we cannot escape that. So besides inflation, probably the next thing we think about is the employment. Can I have the next page? Because that's what the economy is all about, right? It's about people having jobs, earning salaries, and spending this money, and that's what makes the economy going. So employment is critical. And here I showed two measures of employment. My personal preferred measure is the golden line. It's prime age participation rate. The white line is more traditional unemployment rate. No matter what you use, it's strong. But if you squint, you're beginning to see some unfavorable trends. So here we show 10 years of data. COVID, of course, COVID was what it was. It was not helpful. But broadly speaking, the orange line, labor force participation, the 83.4%, it's high. It's trending higher. And the white line, 4.2, again, it's low. This is good, right? But let's dive a little bit more into it. First of all, the latest job report showed that, which was released in May, that the economy added 139,000 jobs. The way to think about kind of the neutral number for neutral growth of the economy, it's about 250,000, roughly. So 139, it's good, but maybe not as good as it could have been. More worryingly, remember I mentioned that all these numbers are just estimates. The previous 2 months were revised lower by 90,000 jobs. That's a significant revision. This is not helpful. Then we look under the hood. What we see is that the job growth is concentrated more in what we call defensive sectors, which are not as sensitive to manufacturing or economical cycle. So a lot of jobs job growth rather, came in education, healthcare, hospitality. It's all good. But manufacturing, for example, saw a contraction of 8,000 jobs, which is, of course, a little bit ironic because the whole point of tariffs is to increase manufacturing, right? So this is not a positive sign, right? It's again shows towards potential problems down the line. You look at unemployment, again, 4.2%. This is good, but maybe not as good as what we had in 2022 when unemployment, not peak, but the lowest point of unemployment was 3.4%. So you're beginning to see these pressures building up an economy, and again, just a matter of time before they kind of spill out and continue. And again, keep in mind, this is one of the venues how tariffs may be absorbed in the economy. Not helpful, but that's a possible outcome. And of course, the third dimension of the economy is the GDP. I'll have the next page, please. And that's what we think about when we think about the economy, right? What rising tide lifts all boats, so the more the better. In the last print of the GDP, again, it's an estimate. We'll probably need to wait 1 to 2 years to get a solid number. So latest print was minus 0.2%. It's most definitely a red herring. This was really driven by building up inventories by the importers to stay ahead of the tariff game. Imports do not reduce the GDP, this common misconception. So I'm probably thinking more in terms of annual growth, and the annual GDP currently stands at about 2.1%, which again, it's a good number, but it's getting close to the stall speed. So the way to think about the GDP, there are probably two main factors driving the growth of the economy. One is just the growth of the population, right? Just the economy naturally expands either through immigration, which of course is under pressure, or just through natural, more people enter the job force. So the population growth on average is about 1% a year, right? So this is kind of your natural tailwinds to the economic growth. And the rest of it comes from the productivity growth. So given this breakdown, 2% is roughly where the Federal Reserve and economists beginning to take notice, right? This is close to the stall speed. And it's good, but it's not as good as could have been. And of course, we talk about tariffs and domestic volatility in politics. But the United States is the most major economy globally. It will impact everybody else. So the World Bank just released their forecasts. Again, everything needs to be taken with a grain of salt, but they forecast the GDP growth globally at 2.3%. That's a reduction from the late 2024 of 3.1%. Again, it may not seem like a huge revision from 3.1, 2.3. It is big. It's huge, actually. It's not helpful, and unfortunately, where it will hit is mostly the developing economies, the emerging markets. So some preliminary estimates is the GDP per capita in the emerging markets may contract by 6%. It's a big number. 6% is actually, it's a lot. And I saw some estimate that it may take up to 20 years for the emerging economies to dig out of this hole. So again, if you think about 20 years, again, everything I say, take it with a grain of salt, but it's a big shock. And it will be felt globally everywhere. But as things stand right now, if you look at these charts, and we're showing 10 years of history, COVID again was COVID, but you don't really see these pressures yet. But putting it all together, to the next page, please. Inflation and the growth of GDP. These are two main dimensions of economy. And here you see the forecast. This consensus forecast with rarely meets the reality. But the blue line at the top, that's inflation, PC. So the most likely outcome, inflation is going higher. The forecast for GDP, it's going down. It's probably the most likely outcome. Put it all together, these divergence of these two lines, there's a term for it, it's called stagflation. Again, you need to be a little careful throwing these terms around because it's a scary term. If you look at this magnitude of these numbers, they're not helpful, but it's not the end of the world. We can deal with inflation moving to 3%. We can deal with GDP decline to 1.5%. Anything beyond that will be a problem. And again, it's going back to what I said earlier, is the environment of uncertainty, which presents most of the challenges. And it's everywhere, right? You see it in the consumer confidence. Consumer confidence dipped to the lowest level in the 21st century, putting aside the recession, right? It's not helpful. If you look at the businesses, at hiring managers, you see the softness everywhere. And until we work out this uncertainty, at least until we know where we stand in this environment, this will continue. It's filtering into the broad economy and into the markets. So, of course, when I talk about the economy and markets, the first thing we think about is the central bank, right? So, obviously, it's a capitalist economy, a few markets, but these markets are managed, and they're managed by the central banks. Can I go to the next page, please? And here you see the last 20 years of action, of changes for the four main central banks globally. Obviously, United States, Europe, China, and Japan. Few things to point out here, which is important in the context of this uncertainty. So first of all, the policy of the central banks historically have been highly coordinated. See these four lines, they kind of move together. The other thing you'll notice if you squint, that the line at the top, which is the Federal Reserve, they tend to be more aggressive. What I mean by that, they're usually leading the change. So the Federal Reserve usually the first to raise the rates and the first to cut the rates, and the rest of the world follows. And that's not an accident. It's just simply, first of all, this is the largest economy in the world. That's the largest consumer in the world, but also it's a reflection of the reserve status of the dollar. And here we see a divergence. So this time, yes, the Federal Reserve was first to start raising rates, but now we're slow cutting the rates. And again, this is, remember the previous chart, the expectation is that inflation will be moving down globally. The economies will slow down, less so for us. But be it as it is, currently the rates, federal fund rates stand at 4.5%. We're reading tea leaves about the future, but the current expectation is, which is changing every day, that there will be 1 to 2 cuts before the end of the year. Obviously, there's a fair amount of political pressure on the Federal Reserve to cut the rates, which so far they've been not taken into consideration. They remain data-driven. And a likely outcome that there may be about 4 cuts next year. So by the end of next year, the rates will move down to 3.25. which will absorb a lot of shocks. And of course, these are just, when we talk about Fed fund rates, it's very obscure rates charged on the reserves, on the affected commercial banks, how it affects all of us through the yield curve, right? That's what affects about the economy. Can we have the next page, please? So here you see the yield curve, and we showed 4 yield curves. Let me just walk you through them because that's important to put it in the context. Starting with the red line, which is June 2019. This is shortly before COVID. This is what kind of normal-ish yield curve, maybe not as much upward sloping as you expect, but this is a good environment. We're going into COVID, that's the orange line. Of course, the Federal Reserve started to stimulate the economy, they're cutting the rates. The front end of the curve collapses to nothing, exactly as we expect. And finally, the blue line. This is December of last year. This is shortly before the Trump administration took office. This is more curve normalizing. You still see the impact of COVID. People complain about the inverted curve. You heard about curve being too flat. And now moving towards the gray line, which is today. Well, 2 days ago. You look at it and say, what's such a big drop, right? It looks almost the same. There's almost no change. The devil is the details. Even though only a few months separate these 2 dates, there was a lot of action in between. There's a lot of volatility, a lot of moves in the rates. We settled as of for today. You see that the front end of the curve, the gray line, it dips slightly lower. And this is here the expectation of the market. Like the 2-year rates is usually the reflection of market expectation of the Fed fund policy. We just talked about Fed funds coming down. So it's not surprising that the 2-3-year point is moving lower. That's fine. But what's more worrisome is the long end of the curve. Even though doesn't look like a lot, the move about 30, 40 basis points, it's highly significant. And it's actually not a domestic phenomenon, it's happening everywhere. Probably the most troublesome change was in Japan, where of course the level of government debt is about 240% of GDP. So small changes in interest rates means big changes for the government, how much it's paying in interest. But what technically we call it risk premium, which is a fancy term for just saying nobody knows what's going to happen. When nobody knows what's going to happen, you want more compensation for higher rates, more returns, right? And that affects the economy globally. It affects the economy on so many levels that we don't fully understand it. Just if you dip like about a year ago, there's a lot of talk about banking crisis. If you remember the Silicon Valley Bank, several mid-level, mid-sized banks failed. Why they failed? Because of holding US treasuries. And they were bought before the current run-up in the rates. And they had a lot of unrealized losses on their books. Well, guess what? The same problem is still there. Right? We worked out 2 or 3 banks. The other banks can come under pressure. It will show up through mortgages, right? A lot of people holding mortgages, and will put downward pressure on housing activity. It shows up in corporate borrowing, right? Operations mostly fund operations through borrowing funds. So this is really where most of the actions is. That's the area to focus on. And again, this is not helpful. So far, we don't see big impacts, but the direction of travel is not very encouraging. And why is that? At the next page. We obviously talk mostly about the domestic economy because that's the most important economy. And your portfolio is heavily weighted towards holding domestic assets. The reality is nobody's insulated. There's just one planet, everybody's connected. And the returns of your portfolio to a large degree is driven by the capital flows globally. So look at these 2 lines, just to put it in perspective. The line at the bottom, the blue line, these are net holdings of domestic US investors, holdings abroad. This is how much domestic investors invested, moved capital outside the United States. You can see currently stands at 36 trillion. The red line at the top, that's the investments of the foreigners into the United States. 2 things to note. First of all, Look at the gap. 36 trillion to 62 trillion. That's what? $0.8 trillion. It's a huge number. So global GDP is about 107 trillion. It's a lot of capital. Why was it very high? It's very simple. You heard a lot about American exceptionalism, and it's really the superior performance of American assets. The same reason why your portfolio is mostly invested in American assets. And also strong performance of the dollar, provided tailwind for foreign investors. Just think about what's happening to the markets if this trend starts unwinding. If we go back to where we were in 2014, that's a massive outflow from American markets, both in equities and treasuries and corporate bonds, in private assets. That will not be good for American returns. Again, remember, everything is connected. There's just one planet. And I usually try not to focus on one country because what affects one country affects the rest of the world. Again, as of right now, we don't see that. Where we're beginning to see some tremors is the US dollar. And typically, the trend is higher interest rates domestically mean the dollar moves higher. And that's very simple, right? So investors getting more compensated for higher rate in the United States, meaning dollars getting pushed higher. That's not what we saw in the past few months. The dollar is actually moving lower. This is highly unusual. Again, we're not talking about huge changes. The dollar moved lower about 4 to 6%, depending on the date. But that's the dynamic we typically see in emerging markets. That's highly unusual for a developed economy that issues that in its own currency. We can always create as many dollars as we want. We'll never fail on treasuries. We'll never fail anywhere. So this dynamic is indicative of growing unease globally with where the American economy is going, potential taxes on capital flows. And again, this is not helpful. But we don't see it yet. On the next page. Probably the most telling market is corporate spreads, right? And these are the thing about equities. You invest in equities, all institutions invest in equities, but a lot of this is driven by retail investors, which are more of a kind of sentiment flows. When you move to corporate market, it's all about institutions. That's where people tend to be more rational, longer-term investors. And here we show the 3 lines. So first of all, the green line, which I didn't show you before, this is the policy uncertainty index. The level's not important. What's important is the trend. You can see that the green line, yes, it spiked a little bit during the crisis periods. Where we are today is off the charts, like literally off the charts. Normally, the uncertainty in the index will feed into credit spreads. And high credit spreads mean that it's getting more difficult for corporations to borrow, which of course puts downward pressure on economic development. We don't really see much happening right now, and that's a positive, encouraging development. The red line, investment grade spread, it stands now at 84 basis points. If you see any drama there, I don't. It's all good. High yield does a little bit different story. So high yield slightly elevated at 300 basis points. But you need to be a little careful thinking about high yield. So here we show you 10 years of history, but there was a really seismic change in the market structure. And the name of this change is private credit. So high yield currently stands at about 1.8, let's call it $2 trillion, total volume outstanding. Private credit actually happens to stand about the same. It's about 1.9 trillion. And what happened in the past few years, a lot of more difficult lending, more distressed borrowers moved actually in the private credit. So the quality of high yield moved higher, it got stronger. And that's one of the reasons why you see the high yield spreads slightly elevated. But again, we're not talking about significant pressures. And as far as your public market portfolio goes, it's a positive message for now. So I'll pause here. We'll talk more about the performance of the portfolio later, but any questions? It's a very fast around global economy with a lot of things happening.
A lot to take in, Ed, but thank you. Any questions for Ed? Thank you so much for that. Great. We move on then. Let the record show that Anthony Giordano is present. Now we move on to the net zero update. John, thank you. John, and
I will do so.
Lots.
There's a lots going on.
Thank you, John.
Good
Welcome.
morning, everyone. Thank you
Morning,
so
John.
much.
Welcome back.
Jimmy Ann's online, if you could share the slides. Great, thank you so much. So, good morning, I'm John Adler. I'm Chief ESG Officer in the Bureau of Asset Management. And today I'm going to do a brief, go back to the first slide, please. Today I'm going to do a brief review of the 2024 Net Zero Annual Report, which went out in April, and then go over 2 recommendations stemming from that report and the net zero work that has been happening for TRS. So starting with the annual report, sorry, Jimmy, could you go back to—
Sorry about that.
Slide 3. Okay, great. All right, we're starting the annual report. That's fine. Slide 4. So starting with the carbon footprint for the board. The good news is that the scopes 1 and 2 carbon footprints for your public equity and corporate bonds portfolios in fiscal year 24 decreased. So as you can see in the slide, TRS scopes 1 and 2 financed emissions intensity decreased by 20.3% year over year, which yields a total reduction of 39.5%, where you see the green vertical line. Jimmy, if you have the cursor, yeah, point to that. Perfect. From the baseline of December 31st, 2019. So TRS had set a goal of a 32% reduction in greenhouse gas emissions in the portfolio by 2025. You've actually, now it's gone down by 39.5% as of the end of fiscal year 24. So you have exceeded, your portfolio has exceeded its goal for scopes 1 and 2 for your public markets portfolio. So congratulations. As you can see from the slide, the next interim goal is 59% from that same 2019 baseline by 2030. That's where the dotted blue and orange lines converge at 41% right there. So that if you go down 59%, that means that you're at 41% of your 2019 baseline. So that's where we're hopefully heading in the next 5 years, 6 years, really. Okay, next slide, please. So this illustration shows you the timeline of emissions reductions in the portfolio and the primary reasons for the changes. So the divestment of fossil fuel reserve owners that you voted for in 2021 and completed in 2023 was the biggest driver of emissions reductions. But in addition, the new asset allocation, which was implemented last year, and the increase in value in the top equity holdings, this what do they call the Magnificent Seven? All the big tech companies generally have very low emissions. So as those go up, your portfolio emissions go down. That also contributed. You can see in the middle, that red type is that was the increase in emissions from companies stemming primarily from the post-COVID recovery, right? So emissions went down during COVID because economic activity went down and then went up during that recovery. So that's really why in the previous fiscal year, emissions went up, but then did go down because of these changes I described in the last fiscal year. Okay, let's move on to the next slides. So I'm going to share some high-level results from the annual ESG questionnaire BAM sends to all of your managers each year. This is last year's questionnaire, which went out right at the end of fiscal year 24. We asked the managers to report on whether they have adopted or intend to do so in the next 18 months, at least for the assets they manage on your behalf, a net zero goal on the left. A net zero goal, whether they intend to adopt short-term emissions reduction targets, whether they have Paris-aligned emissions targets. All of that is in whether they have them or intend to do so in the next 18 months. And the blue bar is in terms of number of funds. The orange is the AUM. You see, some of your managers manage, more than one fund for you. So you see that distinction, and you could have a lot of funds doing something, but that don't manage much assets. So that's why you have those distinctions. The last bar, the last set of bars there on the right is that this is the number of funds and managers that said that they intend to submit a plan for decarbonization or net zero for you by the June 30th deadline that you set for June 30th, 2025. So, 3 weeks from now for public markets managers. And you can see that it's about half that said they intend to meet them. However, that was last year. I am happy to report that we have engaged with virtually all of your public markets managers, and we now expect all or virtually all of them to submit plans by the end of this month, and we will assess those plans beginning this summer and plan to report back to you the results later this year. Also, bear in mind that you set a deadline for private markets managers of a year from now, June 30th, 2026. So that's when those requirements will start to apply to your new public markets investments that you would invest in basically starting July 1st, 2026. The annual report itself contains a lot more detailed results from this annual ESG questionnaire. And you also received, when we sent you that report, a detailed appendix with manager by manager answers to the questionnaire, because that was in the net zero implementation plan. It's a bear of a thing, but if you want to look at it, obviously you have it. Okay, let's go to the next slide. So this slide shows the percentage of scopes 1 and 2 public equity and corporate bonds financed emissions of TRS that have adopted science-based targets as of June 30th, 2024. As you can see, year over year, the financed emissions covered by validated SBTI targets, as well as the amount committed to SBTI, each went down by 1%. So essentially, SBTI adoption stagnated during fiscal year 24. So I have to say, I'm giving you the good with the bad. We are not on track to achieve the goal that you set of 70% of your scope 1 and 2 emissions covered by science-based targets by 2025. We may do a little bit more this year, but the reality is that this progress has stagnated. SBTI, the Science-Based Targets Initiative itself, has had some challenges, including leadership and staff turnover, lack of protocols in some high-emitting sectors, including energy and utilities, and they remain committed to very, very stringent standards, which a lot of industries are resistant. So we are working on identifying other target-setting methodologies and metrics that would be both credible and useful for the goals that you've set. And I'm going to get into that now in the next slide, because this is around portfolio company engagement. So these are some highlights of the portfolio company engagement on net zero that have taken place over the last year. We've now sent letters on your behalf to 100 of your portfolio companies in the highest emitting sectors. And we're engaging in substantive dialogue with many of them around these target setting protocols and methodologies in addition to SBTI or as an alternative to SBTI. Next, we continued our engagement with major banks this year, urging them to disclose their clean energy supply ratios. Last year, 3 banks agreed to this disclosure. This year, none of the 4 banks, the other 4 major banks that we filed shareholder proposals at, agreed to that disclosure. All 4 of them tried to get the SEC to allow them to exclude the proposals. They failed in that, so all 4 proposals went to a vote. But in a sign of the times, the average vote on the proposals this year went down to 15.5%, whereas last year the proposals, the same proposal that went to a vote, got an average of 26%. And this is really an indication of what's happening with social and environmental shareholder proposals in the current era with the anti-ESG campaign and the powers that are ascendant in Washington. I think everybody at the table knows what I'm talking about. The last point here is just that we are serving on your behalf as the lead investor for Climate Action 100+ for science-based targets, and are helping really to drive that work forward for asset owners and asset managers in that coalition. Okay, next slide, please. Let me talk about utilities. You may remember that we've been focusing on science-based targets in utilities since 2023, as it's such a big chunk of TRS's Scope 1 and Scope 2 emissions. It's 25% as of 2024. We have been representing you on the stakeholder advisory group for the development of smart targets, led by an industry group called the Electric Power Research Institute. Now, I'm just going to say, we're not sure yet whether this methodology will result in utilities actually adopting science-based targets. The public comment period for this methodology begins in July, so we should know later this year whether this approach will help get utilities to be genuinely Paris aligned. I wish I could give you a more definitive answer today, but I can't, but we will know more later this year. I'll just also note that we did file shareholder proposals this year on behalf of TRS and other systems at 3 utilities, requesting that their targets be evaluated by independent third parties. It's really a way of saying these are utilities that have adopted targets, but we're a little skeptical that they're really science-based or aligned, Paris aligned. But again, continuing the trend, these proposals really did not do very well, receiving an average 9.3% vote. So, the shareholder proposals this season have not really done very well, and that's the time we're in. So we're going to evaluate that going forward. Okay, next slide, please. This concludes my overview of the annual report. I encourage you to read through the whole report, at least the executive summary, which is in your portal. I'll take any questions now on the annual report, and then I'm going to go to one recommendation right now.
Any questions for John?
Okay.
Thank you, John.
So let's do the next slide, Jimmy. This slide is, and I realize there's a lot of numbers on there. Here's your results in terms of your investments in climate solutions. The good news is that your total investments in climate solutions are now up to $6.4 billion. Jimmy, if you can point to it on the thing, $6.4 billion. That's your exposure as of year-end 2024, so December 31st, 2024. And that amounts to 6% of your total portfolio. Investments have increased pretty much across asset classes. The highest actual amount is in public equity, which makes sense since that's your largest asset class, while the highest percentage in climate solutions is in infrastructure, where nearly 25% of your allocation is invested in climate solutions, which is mostly renewables. Now, you'll see, okay, can we go to the next slide, please? So this slide was actually duplicated from last year. So you have now exceeded your 2025 goal for climate solutions, which was $4.2 billion. We do not, the board has not set a 2030 target. We have a 2035 target, which is $19 billion. But the BAM is recommending that you set a 2030 target. And the target that we're recommending is based on your updated strategic asset allocation and capital markets assumptions that come from Goldman Sachs. The updated actuarial projections for the system's assets under management, and then we use the same compounded annual growth rate that we used back in 2021 to generate the 2025 and 2035 targets when you adopted them. So if you go to the next slide, please, Jimmy. So the number that we're proposing is highlighted in green, 10.5 billion. So that, and I think what's important, so you're currently at 6.4 billion, which is 6%. And we're proposing 10.5 billion, which as a 2030 target, which would be the projected 7.2% of your total AUM in 2030. And again, this is the recommendation of the Bureau of Asset Management, and we would propose that you consider that target when you vote. Any questions on climate solutions?
Any questions for John?
Okay, we're going to stop there for now.
Okay, and we can settle that now. We'd like to table that recommendation.
You'll table that for today.
Yes.
Understood.
Okay, thank you. Thank you, John. The definitions. I thought he would have a second recommendation.
So that was gonna take an executive.
That's right, that's right.
Well, too
Record
specific.
will. Yeah. Okay, so now we'll move on. Thank you, John. Much appreciated. We'll move on to the new MWBE definitions memo. I think maybe Taffy is gonna do. Hey, Taffy, how are you?
Hi, good morning, everyone. Good to see you.
Great.
Okay, so I am going to just walk you through the memo that you should have in front of you and just quickly highlight some of the key definition changes and open up for any questions that you might have. Our previous definition for MWBEs was 25% ownership. We are updating that threshold to 33% based on a survey of our peer public pension plans and just overall best practices in the industry. All investments made before July 1st, as you all know, our fiscal ends June 30. So all investments made before the end of the fiscal will retain legacy status under the 25% rule. And we just ask that all managers who are at that 25% threshold at least maintain 25% ownership by women and people of color. The other key definition update that I will highlight is there's a new definition. If you noticed, we wanted to be very clear on the different types of definitions that we have. In public markets, we've historically had 51% ownership for MWBE, but we noticed that a good number of our private markets firms also maintain 51% ownership. So we wanted to highlight and distinguish majority-owned MWBE managers versus what we're calling substantially owned MWBE managers who will now be at that 33%. There's a third category that we're adding called diverse economics MWBE managers. This the decision to add this definition is in line with trying to create more of a pipeline of women and diverse managers in the industry. So if a firm, a private markets firm, has women and people of color retain at least 33% of the participation in the fund economics or carry, we will consider that fund a diverse economics manager. So I hope that makes sense. So this is broadening the aperture in hopes that some of our larger firms will elevate and promote the utilization of diverse members of their teams on their actual funds. Lastly, I will highlight a new addition, which will be adding a 3% of AUM goal, aspirational goal for disabled veteran-owned businesses. We thought that this was very important. Our veterans are a very important part of our country and our business community, and having a separate goal to try and capture more veteran-owned firms is something that we thought would be important to all of our boards. This was presented to police and fire already. They have asked that we broaden the definition even further to include just veterans, that they don't have to be disabled, but they're also asking that the individuals would have been honorably discharged to be able to receive that designation. So I would like to present that as well to teachers and really just open it up for any questions that you might have. Those are some of the key highlights of this memo.
Thank you, Taffy. Any questions? Anthony?
Taffy, just in terms of knowing the rule, do we need a disparity study for to make such a change in terms of veterans?
We don't necessarily need a disparity study. That 3% that we put as an aspirational goal, I noticed that some of our larger managers already report, Grosvenor and others already report on veterans, and it's usually like a 3 to 5% goal. I figured if we put a lower number, we can at least start asking the question, collecting the data, and I can present that back to the boards once we have a baseline from our 2025 fiscal year data.
It's called just, and I know we're like-minded in this. Does that potentially open the door for us to request similar aspirational goals for specific ethnic groups?
I don't think we would necessarily have to do that. If you've taken a look at our report, our MWBE report annually, you can see by demographic what the exposure is, by asset class, by system. If there are questions about that specifically, if anyone feels like there's more disparity with specific ethnic groups, I'm happy to talk about that some more. But we've been very transparent the past 3 years in terms of highlighting which demographic groups are allocated to in our portfolios.
Thank you, Taffy. Any more questions or concerns? We're all in agreement with this. Okay, thank you.
And just one question. Did you all want to stick with veterans or disabled veterans? Just wanted to make sure if we have just uniformity across all of the systems, or
Yeah, I would think veterans.
veterans broadly. Okay.
Yeah, it's fine.
Wonderful.
I agree with that.
No reduction.
Great. Thank you, Taffy.
Thank you all. Have a good day.
Thank you very much.
Bye-bye.
I think that concludes our work in the public agenda session. So do I hear a motion to move into executive session?
So moved.
Second. Thank you, Valerie, and thank you, John. Yeah, Valerie. Yeah. It's like Victoria.
Take it with a B.
Victoria. Thank you, Victoria. Thank you, John. And thank you, Valerie, for bringing it to my attention. Any comments or discussion? All those in favor of going into executive session, please say aye.
Aye.
Those opposed say nay. Abstentions, we're now in executive session. Thank you. And we are back in public session. Welcome, everybody. At this time, I believe we'll have a readout from our own Priscilla Bailey.
Thank you, Tom.
Thank you.
Mr. Chair. Appreciate it. In the executive session of the Passport Fund, there were 2 manager updates. There was an update on investment manager contract extensions. Finally, in that session, there was an international equity presentation. Consensus was reached. In the executive session of the Pension Fund, there was an update on preliminary performance. There was an investment policy proposal. The matter was tabled. There were 2 infrastructure presentations. Consensus was reached on both. There was an alternative credit presentation. Consensus was reached. There was a real estate presentation that was previously tabled from the May 2025 investor meeting. This matter was also tabled in this session. Details to be made available at the appropriate time.
Thank you, Priscilla.
Thank you.
Appreciate it. And I believe that brings us to the conclusion of our public session. And as always, before we ask for a motion to adjourn, I'd like to publicly thank our recorder, Will, and our TRS tech guy, Richard. Much appreciated, as always.
And I'd like to thank you, Chairman, for your stewardship of the fund.
Thank you, sir. Before we adjourn, off the record?
No, well, we're in public session, so I'm going to go off the record.
We are in public session.
Yes. Yes, sir.
Correct. So strike that out. And I will ask for a motion to adjourn.
So moved.
It's been moved.
Second.
Seconded.
Second.
Any questions? Concerns? All those in favor of adjourning, please say aye.
Aye.
Those opposed say nay. We are adjourned. Thank you.